why would you invest in a country that has total lack of stability in their currency? Now, that has always been a big problem. And usually because those countries tend to sort of devalue their currency to improve their exports and so forth. So very export-led economies. And so that has a cost on the currency side and ends up having issues on inflows of foreign capital. Like right now, the US is at a 90-year low in terms of its gold reserves. And the rest of the world is at a 60-year, 50-year highs in their gold reserves. People are starting to realize that gold is cheaper in the ground than cheaper above ground, right? So you can buy, so think about this. You're trying to accumulate gold. Your main goal is like, oh my gosh, I see all these countries rushing to buy gold. My options are I buy gold at 36, 37, 38, $4,000 an ounce and keep pushing that higher. And so my buying power is actually being reduced by the fact that gold prices keep being pushing higher than relative to my purchasing power. That's an issue every country will have. Or you can buy ounces today, in some cases at $100 an ounce, $200 an ounce, some cases even lower than $50 an ounce. These sovereign institutions are going to start figuring that out. They are figuring it out already. And they're going to start partnering with either private equity funds or other funds to acquire, to help these companies get producing assets into production. And if you look at the model projections of these companies, they are still in a backwardation. So what does that mean? That the future gold prices applying in these models is in backwardation. It's supposed to fall, not rise. Okay? So right now I'm looking at a few things, and gold prices is sitting at 3,700, and the model projection for 10 years from now is that gold prices would be 2,500, 30% lower. People don't know about this, but Ibovespa, the most boring way to invest in Brazil, if you put $1 million into Ibovespa in the beginning of early 2000s, you would have grown your money to about $18 million. Your IQ in markets can be very dangerous because the more you have a very high IQ and you're trying to be too cute, understanding when to come in, when to come out perfectly, that's not the way to build wealth. Actually, it's very difficult to do that because markets are very unpredictable when you get to that kind of stage.
I'm your host, Fazan Irani. Let's connect the dots. Our guest today is Tavi Costa, a macro strategist at Crescat Capital in the USA. He's responsible for developing Crescat's macro models as part of their thematic investment process. His research has been featured in financial publications such as Bloomberg, Fox Business, CNN, The Wall Street Journal, Yahoo Finance, Reuters, and others. Tavi is a native of Sao Paulo, Brazil, and is fluent in Portuguese, Spanish, and English. Welcome, Tavi. It's a pleasure to have you on our show today.
Thanks for having me. Looking forward to this conversation.
So am I, Matt. You're a difficult man to get hold of, obviously because of the amazing research that you do. So here we are. Thanks for your time. To start off with, Tavi, just for the audience to get to know you a little bit, in your own words, could you tell us a bit about your journey and how did you get into financial markets?
My journey in financial markets, I get started with my experience with money in general, which maybe dates back when I was a teenager and my dad went bankrupt in his business, and we went through a very difficult time during that period that sort of kind of shaped me to see money as security, not and mostly. And so I began to work towards making potentially better decisions when it comes to deploying capital and starting things. I got into business administration initially in college, just for reasons that I wanted to keep this very broad and then see where my passion would follow, and end up falling in love with finance with a few classes that I took in college, and was, you know, basically reading 4 or 5 newspapers a day. Was very familiar with markets by end of college. Ended up getting a job at a hedge fund after college, and developed my work on emerging markets. Built a big theme on how I thought China was going to hit a wall of debt and sort of have its own Lehman Brothers moment. Um, After that, that actually really got around, and in terms of media, there was not a lot of people talking about it. Then Trump came in, and China became a thing, um, and we saw trade wars, and all these things became something that no one was really expecting before. And we start questioning things about, our supply of and needs of medicine and other things that were mostly related to Chinese infrastructure. And so now those things have become very popular topics, but back 2013, 14 was certainly not an idea. But I had developed this, kind of way of investing in macro trends and foreseeing big macro ideas that I try to express my opinions in markets as best as I can. And back in 2018 or so, I saw a chart where commodity producers are very depressed when it comes to not only valuations, but also deployment of capital into new mines and new, producing assets. uh, didn't know which commodity I was gonna really dive in as far as expressing that view. Looked at the duration of mining and realized how long it takes to build a mine and get new supply um, into the market. And it was clear to me that mining was not only a legacy industry that is here to stay, but it was very mispriced relative to where if metal prices were substantially higher. So I got involved in this and been managing money for clients in that space for a while now. And I would say that the next wave of these ideas is probably going to be emerging markets. As part of all this is likely to be as asymmetric as mining and commodities were maybe 3, 4 years ago, especially mining that has been moving now. So I would I suspect that emerging markets are going to be in a similar position 3 to 4 years from now.
Yeah, you're a very modest man, Tavi. You're saying you just dabble in it, to be quite honest. I've been following you on LinkedIn for quite a while. Some of your charts just amazing, and then obviously you get interviewed on the big channels as well. Do you want to talk us through some of your bigger macro thesis around these? Because I've seen your charts, but some of our audience might not have seen it. What is your bigger thematic view on long-term cycles playing out, and where are we in that period, so to speak?
I think you want to always operate under the assumption that of how either assets will perform, or it's either because of allocation of capital is about to rotate into a new place, and prices of those assets are not reflecting that yet, or there are major imbalances that will eventually drive policymaking um, to certain constraints that will also set the stage for certain things that have not been, really attractive for investors that may become attractive. And oftentimes, people think that I'm always chasing a contrarian opinion, and that's definitely not the case. I think when you can marry a great idea with a lot of potential for growth, and also you find something that is contrarian, that those are the best ideas you can find. That's sort of like mining a few years back, and why I'm saying emerging markets, because of course, buying a mining company now versus 3, 4 years ago, it's a different risk reward proposition. And I still think that emerging markets offer a very similar risk reward opportunity today. And so that's why I mentioned that. But what are the constraints we may have in the future that can force policymaking? Well, the U.S. is facing a very significant amount of debt. So is the world. But why the U.S. matters so much? I did a research maybe a year ago that really added to my views. Usually, you see things kind of developing through chapters. Um, so we had a lot of imbalances coming into the COVID recession, and the policy response from that was a lot of money printing and debt creation. And that immediately had the first impact that we saw, which was inflation out of all that. And inflation in goods and services, not talking about financial assets inflation, which was present at that time already. As we saw that developing, eventually inflation drove the treasury market to start being more questioned. Uh, we talked a little bit about the 60/40 portfolios before this interview started, but that began to sort of, you know, question that allocation. I mean, should we have 40% of our money into fixed income, and what's the risk of things like treasuries and others? And those are all fair questions. Then we saw the Russian invasion uh, into Ukraine, and that whole situation led to um, treasury selling. Nothing to do with inflation, but a lot more to do with the fact that those central banks were looking for gold. We're looking for a neutral asset to own that has history, centuries of history. And so gold became this sort of obvious alternative for central banks. And so it begs the question now where we are in the situation that and during that moment, I've always been sort of more bullish on the dollar, right? I mean, and that really comes from this whole, analysis that we've done on China and other things that I've always thought that the Chinese currency was very overvalued. Now, what changed a year ago or so was when I start looking at the interest payment on the debt that we have here in the US, which is close to 5% of GDP. And although a lot of people know about that, what they, in my view, underappreciate is the fact that there's no other economy today in the world that is as big as the US or as big as any country in Europe or Canada, Japan, and others that is running anywhere close to that amount, which puts the US in a position of greater sense of urgency to lower rates relative to those other economies. And then paired with that analysis, I saw that the dollar, from a trade adjusted basis, is at one of its most overvalued, or was at that time, and it still is one of its most overvalued levels in history. So something's got to give, right? So if you know of a country that has to lower rates no matter what, no matter where inflation is, they have to lower rates more than Germany, more than Japan, more than Canada. That was my view. I thought that sense of urgency reflected in markets at some point would also have an adjustment on the currency side. That led to another conclusion. Well, why, and this is talking to institutions and other capital allocators, why somebody avoids investing in a place like emerging markets. So why emerging markets? Because emerging markets usually are linked to commodities. When you trigger a gold market, you trigger a commodity market, you eventually trigger an emerging markets boom. And so I was fascinated by the the lagging effect of that because eventually money is going to fall there at some point, and I was wondering what would make that a catalyst to change that whole rotation of capital. And what I found is that the reasons to not invest in emerging markets usually comes down to two things. A lot of people focus on the corruption and the problems we have, but we've seen in the past emerging markets do very well, and the corruption scandals and problems was still the case. Like we didn't see those things change. So structurally, it's not a case to be saying that we're going to see political shifts and anything like that in those countries. Like I do think there's going to be still a lot of problems politically in those countries. But the two main factors that avoid somebody to invest in there is a very strong dollar. Why would you invest in a country that has total lack of stability in their currency? Now, that has always been a big problem. And usually because those countries tend to sort of devalue their currency to improve their exports and so forth. So, very export led economies. And so that has a cost on the currency side and ends up having issues on inflows of foreign capital. Um, and the second thing really is yields. Like if you have an environment where the US yields are too high relative to the rest of the world, you tend to see a place where money, wants to find its way into something safer. And so finds its way into treasuries, of which I just told you that I have a different view on this because I think treasury yields in the US are going to force to be lower because of the debt problem. And so all right, so you have a situation where you may have constraints on the yield side, uh, and the dollar may devalue substantially versus other fiat currencies. That's a green light on emerging markets to me. So, yeah, I'm extremely bullish in that area. I've said this to somebody the same way. Some people come to me and say, "Hey, you were talking about mining. Look where mining is now. That's um, I don't come from a place of thinking of these things about being right or anything like that. But if there is a thesis, I think is still ahead of us and presents such as interesting opportunity as mining was a few years back. You know, in a certain way, you're just as good as your last idea. So,
Yes.
um, I think emerging markets is going to be that next idea. So I'm focused on the next thing, although I'm very invested in mining. I think that's also going to be a very interesting place to be investing in the near future.
Italy, there's a few good points you made then. We'll go into the mining and we'll also cover the commodities and even emerging markets. I do want to go there. But just bringing it back to the US interest rates and the inflation, recently the US Federal Reserve has cut rates and inflation is still roaring again, right? So, do you think we're going to see some kind of financial repression in the US? Because obviously, if inflation is already coming back on and people are losing jobs, are you seeing this as a stagflationary period where they will have to kind of offer lower yields to investors on the treasuries just to kind of get out of this debt problem, which you mentioned? US has one of the biggest at 37 trillion now, isn't it? How do you see that?
Yeah, I think that you have, the mandate of the Fed, it falls into inflation, stability, and labor markets stability. And on the labor markets, I think there's a lot of mm, potentially noisy signals. I don't know exactly what to make of it.
Is the data being fudged? Do you think the data is being
No,
fudged?
I don't think that's the case, actually. I think what's happening, maybe that will be the case, right? But I think what's been happening is, and the reason why this is so bizarre, it might have to do with AI. That's where I'm coming from with this analysis of labor markets is that we're seeing the deterioration of labor markets, and historically, you tend to see that in line with um, companies starting to see a fall in their profitability, and we're not seeing that. And so in other words, you're not seeing that classic situation where a company is just firing people because you're struggling. Like that's not happening. We are seeing a situation where bigger companies are attracting more capital, right? The Max 7 economies, the parts of the economy and so forth. But that doesn't mean that the other part of the economy is in a recession, anything like that. I mean, the data doesn't suggest that either. They're not booming, but they're not in a situation that we've seen in the past where they start cutting their expenses by firing people either. But at the same time, we're also seeing a lot of people get fired. Um, and a lot of people is actually coming from the government, believe it or not. So, which makes sense. They've been trying to make the government a smaller entity and so forth. And so we did see that in the data. Um, and I'm suspecting a lot of this has to do with AI. People actually losing their jobs because of AI. I don't think it's going to be the end of the world, but I just think that there's a little bit of noise in that data. So on the inflation side, on the other hand, I think there's much more conviction, at least in my analysis, to say where we are. Like the fact that the Federal Reserve decided to lower rates, despite the fact that their main inflation gauge, which is the PCE, is approaching 3%. Not only that, but actually inflecting higher, like clearly is coming back up and reaccelerating. Um, it's a statement. It's a statement that they acknowledge that their actual mandate has nothing to do with inflation and labor markets. It has everything to do with making sure the government can pay its bills and move forward. So, we're seeing monetary policy morph into fiscal policy in a big way where, we have to lower rates to allow the government to spend because interest payments is becoming a larger percentage of how much they spend. And if we want to free up money so the government can have expenditure that is focused on growth, we got to lower interest rates immediately. So, yeah, I think that's the probably the best way to analyze what's happening. Um, is that
So
we're
you think there will be financial repression? Obviously, this is the way forward. You think the Fed will possibly help Trump and the economy or the government by maybe keep reducing interest rates, even though
Yeah.
inflation roars higher? So there is financial repression coming, in your view?
Yeah, I do. I've been of that view for a while, but I think that recently that has definitely taken a bigger um, conviction, at least on my end. And I think the market overall, not just me, but has caught on to that. And therefore, why hard assets like gold have been trading the way they have been trading. And yeah, I mean, there's definitely that issue. I think a bigger question, however, for the Treasury and the Fed and so forth, is how do we like right now the US is at a 90-year low in terms of its gold reserves, and the rest of the world is at a 60-year, 50-year highs in their gold reserves. So the rest of the world is buying gold and the US is just sitting and opting out of that buying spree. How long until the US starts participating in this?
Yeah. There was some noise. I think at the start of this year, towards the start of this year, that there was a lot of tonnage of gold being shipped off to the US. Do you think that could be the government getting some, or is that a bigger entity actually trying to uh, get gold into the US?
Yeah, I actually commented on that a while back, and I said that I wouldn't be naive to the point that the government could certainly be accumulating and actually being the one forcing gold prices higher. I think that that view comes down to maybe two things. If you're in the US situation and you're seeing all these other economies accumulate gold, and you're in Trump's seat, of which is a guy who appreciates gold a lot. Clearly Trump has made enough comments that he loves gold. So, and he's seen all these guys accumulating gold. Imagine being in his position. So, what are the options in his case? Well, number one, he can accumulate gold in the market and buy more gold than these other guys are buying, right? That's one way to do it, but then it's going to push prices higher, and it has other implications. Okay, well that's one option. The second option is if they are sure that they own more gold than the rest of the world, all they have to do is revalue gold. right? Because that makes it more expensive for everybody else to acquire gold, and that's one way to sort of make it safer for them to make sure the U.S. is still is. People get confused, like this whole idea that we're hearing since the 70s that the U.S. dollar is backed by the U.S. military. It's it's not true at all. I mean, it's a new concept that people have been using, but currencies are backed by something tangible, not just I. If that's what you're backing your currency, I would rather own the metal itself, and people have realized that obviously, and the U.S. still has a very large gold reserve. As far as official reserves, we know the U.S. has the largest, but who knows, right? I mean, who knows how much other economies have accumulated in the past? I mean, we know China has been buying a bunch.
Yeah, I've spoken to a couple of guests, and I think both of them, and I've heard Alistair McLeod also say, and through my own research as well, that China could have in excess of 20,000 tons. In fact, I thought Russia also had a lot more. And one of the guests said maybe Russia, not so much, but definitely China would be number one. Not in the official numbers, because most of the gold is also, the official is the one that's held with PLA, the People's Liberation Army. But there is a lot more gold that China has been buying from Swiss refineries. Your views on that? And do you think the U.S. gold even sits at Fort Knox? Do you?
I don't think anybody knows that answer, but I will give you a different way to think about that question. I think that because I'm trying to think about more, not that these are not important questions, but I'm trying to think about practical questions as investors. How can we take advantage of these discussions? Like most gold bugs like to talk about how gold is or silver is manipulated and all these things. And like that's not very practical if you're an investor because okay, if you believe in that, then you should probably not invest in those things, right? Because you think it's manipulated. So what are you doing here? I try to think about as practical as I can be and pragmatic. And I think that one realization that the governments are starting to have that we've had in maybe a step ahead of them because we've been doing this for a while now, is that people are starting to realize that gold is cheaper in the ground than cheaper above ground, right? So you can buy so think about this. You're trying to accumulate gold. Your main goal is like, oh my gosh, I see all these countries rushing to buy gold. My options are I buy gold at 36, 37, 38, $4,000 an ounce and keep pushing that higher. And so my buying power is actually being reduced by the fact that gold prices keep being pushing higher than relative to my purchasing power. That's an issue every country will have. Or you can buy ounces today, uh, in some cases at $100 an ounce, $200 an ounce, some cases even lower than $50 an ounce if that gold is underground. Now then you're gonna add to the other ideas. You're gonna say, well, what about the operational risk? Yeah. But what's gonna happen here is that you're even start seeing these large foreign, no, not just foreign, it's gonna be the US too. These sovereign institutions are gonna start figuring that out, and they are figuring it out already. And they're gonna start partnering with either private equity funds or other funds to acquire to help these companies get producing assets into production and how they're going to structure these things. All they had to do is just do a stream, right? So instead of owning equity in the company, all they own is the right for a certain amount of the production. So let's assume they say, well, 1/3 of the production goes to me in ounces. Okay, perfect. And I'll give you as many dollars for it. Um, and it probably will start friendly and will end badly. It's like some people cheering on that the US government is taking on equity stake on some of these companies today. And like, this is kind of a scary situation because these equity stakes are going to stay here for generations. And we're going to see, different parties come in place.
The one you were talking about, was that the US government taking a 15% stake in a company just recently, wasn't it?
Well, there are plenty, right, that they did, and including Intel, including MP Materials, and some others. But and these things, when they start, like, very unlikely they will stop here. They'll probably go even further. And it's not like 2008 where you saw a bailout of the government to help PCs not go bankrupt. Like, no, that's not the case here. These companies are not going bankrupt. They are they're so strategic that the government wants money into their business. And
Yeah.
as we continue to see that, what's the difference between the US versus an emerging market? I mean, isn't that what Brazil is about? The most strategic companies in Brazil are all state owned, right? And they start that way. And the US is going that direction too. So I think in the resource space, what has been obvious to a lot of private investors is starting to become obvious to government investors, in a way where sovereign institutions will start finding ways to get resources by offering financing capabilities or not. Like, that's that, at some point, this is why people avoid jurisdictions like Africa, right? Because you can wake up one day and the government may say, well, I own 30% of your business. That's it. You have no say in this. And can we get to a world like that in the US? I mean, I don't think we're in the verge of that now, but in the future, sure. I mean, why not? These
So
things,
you
they
think, yeah,
Mhm.
you think governments could actually nationalize mines? Well, not the US's and the Canadas to start off with, but we saw that in Burkina Faso as well. And do you think that is the risk you're talking about? Obviously, isn't it?
I think that's the risk eventually. I don't think we're there yet, but I think where we are now is the beginning of engagement of the government, which, as I said, starts friendly. It starts with the idea of, okay, how about if I infuse this much capital into your business in exchange for that? And that's sort of how everything begins. And then, you know, it doesn't take a lot of brain cells to start saying, well, I've got more power than I thought I had. And maybe I don't need to be negotiating prices. I just take the stake on these things and see what happens. And at some point, we're going to get there. I don't think we're going to get there this year or any time like that. But that's something will happen down the line, because we're going to change administrations. Everyone's thinking about Trump. I'm not even thinking about him. I'm thinking about what's next. And you know, what would the prior administration? How would the market behave if the prior administration was doing what Trump is doing here, right? And what if in 8 years from now that administration is back in the driver's seat with all these equity stakes? Like, I think that's what people are not appreciating.
Yeah, yeah.
I'm not saying Trump is not doing anything wrong either. All I'm saying is this could get, worse. That's all.
I think people are short-sighted, Tavi, and that's exactly what you're pointing out. And the one point you touched out there also is the whole reason of this is, instead of governments buying gold, they just get the gold ounces under the ground, because what some people might not understand is gold might be $35 or $3,600 now, but for a miner, all-in sustaining cost is about 1,500 or 1,600. Even with the inflationary aspect, which is taken over, I think I'd come across one of your charts, which is amazing, which just shows the profit margin some of these miners are making. So obviously, as the price of gold keeps going up, the miners are going to have bigger profits because their all-in sustaining costs are going to not move that much. Do you want to talk around that piece of how your thesis works out and why you actually believe in the miners also in a bigger way?
Yeah, the miners carry operational risk. That's normal, and it's you're taking that risk in exchange for a margin, and that margin today is one of the highest we've seen in history. But how these companies get get priced is that you look at those margins and you calculate how much free cash flow they're making, and you say, well, discount that free cash flow and tell me what the present value is, and that's how much these things are worth. And the problem of that calculation is that everybody is applying, and I mean everybody, like all the banks, all the companies. And I suggest anybody to look into how they're calculating the present value of any miner today. You're going to figure out that there's going to be normal, like, how do you project 10 years out for a new Mont or Barrick or any miner? Well, you got to have a view of how where gold prices will be, right? Or any metal. And so
Yeah.
let me ask you a question, right? Like, if you're the one responsible for that and you're doing this calculation yourself, w- what would you say it's fair to consider that gold prices would be 10 years from now? So you're looking at a business, they're going to be producing for 10 years, and you try to figure out how much they're going to make in those 10 years. And you're going to discount that back and say, all right, that's the value. So, like, what's the appropriate gold price, you think, 10 years from now? You try to be conservative, right? You're not trying to be crazy. Like, that's a
Yeah,
conservative
yeah.
calculation. What do you think it
Yeah,
should
to be
be?
quite honest, it depends. It depends on quite a few factors, but I know it's heading upwards because of the geopolitical effects, and as you said, even central banks accumulating it. I'd say that happily sits at about 5.5 to 6,000 US dollars, if not more. Yeah, given if the currency is also depreciating, so it depends on those two variables there. But 5.5 to 6,000 by the
Okay.
time all of this is over.
And that's a conservative bet, all right. And what I'm thinking that you're coming up with this is because you've seen what happened in the past, right? And you're trying to apply your lessons to the future, and you're saying, well, if this is what happened, let's just say that every year we can see an average 5+% appreciation in the gold price. And so you apply that in your model, right? And then you figure out, all right, well, I don't disagree. Okay, what do you think bankers are doing? Look at every bank, because regulatory reasons and the way this industry is so depressed still, despite the fact gold prices are where they are, despite the fact they're making so much money, people are still not understanding the thesis. And if you look at the model projections of these companies, they are still in a backwardation. So what does that mean? That the future gold prices applying in these models is in backwardation. It's supposed to fall, not rise. Okay. So right now I'm looking at a few things, and gold prices is sitting at 3,700. And the model projections for 10 years from now is that gold prices would be 2,500, 30% lower. Okay. So the price of the asset is being priced today, assuming a 30% decline in gold price. You buy the mine today, tomorrow, what's the value of that mine? It's not what you just paid, it's a lot more, right? If you assume the logic that you just said, that gold prices should be higher. So I don't know. There's different ways you can say this. Some people call opportunities, some others I call it arbitrage. Like, that's what I think it is, right? Like, as long as you're not buying something terrible, you're arbitraging the market, right? If you know what you're doing in an operational side and you're building a good business and you're building a good team behind it, then as long as there's no issues, this thing is not priced accordingly. And so,
Yeah, it's a hidden gem. I would call it a hidden gem, to be quite honest. And that's where some people make the money because you've seen opportunity where nobody else has. And the reason I brought you on also, some of your charts actually, I'm a big history buff, Tavi, and I believe the history repeats itself. Some people just don't see it. And some of your charts actually show that. They show 40, 60, 80, 100-year cycles of how underpriced commodities are. And I believe most people don't understand commodities because mining has got such a bad name in society because of all the global warming propaganda. Do you want to just talk around the use cases of commodities? Because I know it, but for our audience, obviously, with wars coming up, you need commodities, AI revolution, data centers, you need commodities, onshoring, manufacturing, which Trump is talking about, we need commodities. Why are you seeing commodities as such a strong case? Obviously, I know it's a real thing that Do you want to talk me through your thesis?
Yeah, I think it boils down. I mean, the initial reaction I had was that we would see buying of central banks of gold, and eventually you would see a big world where we would go from a globalized environment into a deglobalized situation that would be forcing countries to do a lot of onshoring, rebuild their capabilities, you know, start rethinking their dependencies and reliances they have with China and other countries. And that has certainly been happening. I think what adds to that thesis even further recently has been the AI situation, where AI comes into the picture is that it's very different than the internet. It's very different than the real world situation because those two other times in history were not, they were incredibly productive periods in terms of what we saw coming out of that, and the amount of money that kind of flow into that space of the at that time, and how much was unleashed of economic growth because of those things. What I think this time is very unique about the AI revolution is that different in those times we're seeing the true arms race. It's a situation where the US is definitely racing China and other economies to see who gets there first. um, and so I don't foresee that and in order to get there, we need a lot of infrastructure in place. We need a lot more, energy. We need a lot more, better infrastructure to enable that energy to flow into the electricity consumption we may see. And
Of
number
course.
three,
Yeah.
we need a lot of metals, and other resources to make those data centers, those buildings, and all that. So now you have, buildings of factories and other capabilities on top of also data centers, electrical grids. And like this is probably the biggest construction boom we're going to see in I don't know how many, even centuries. I haven't seen one like this in a very long time. And what I think people are not understanding is, a lot of them say, well, where's the money going to come from? Well, it's very simple. Look at the Mag 7 companies. They carry over $3 trillion in their balance sheets. All they have to do is lever that, you know, 50% or so. There's trillions of dollars just there. That's just the top seven companies. What about the whole technology sector? So you're probably going to see a lot of leveraging in the technology space. You're going to see deterioration of balance sheets most likely to finance these capital spendings. And I think we're going to get into a world where you're going to have spenders and earners, and the spenders are going to spend, and the earners are going to compound growth through receiving that capital that is inevitably going to find their way into energy, infrastructure, and materials. And so, yeah, I think commodities are going to be right at the core of all this. And so they're going to be extremely important.
Yeah. And like even today's world where they say the green agenda and all of that, even the average person talks about solar and wind, but they don't understand that you need steel and iron and concrete to build those towers or the solar panels, and you need silver. I think people just haven't been told the truth about you needing mining for anything. Energy is life, energy is the economy, and governments can't print gas or electricity. So the whole transition, I think the average investor just still hasn't figured out that whether, as I just touched on one thing because you said Trump. Trump obviously is reshoring everything and bringing everything back home. And I think they passed $4 trillion to spend. So you said infrastructure. But even if it was, let's say, Biden administration or the Democrat, or Kamala Harris or the Democrat administration, and they push the green agenda, you would still need mining in the steel and iron to build the solar and wind infrastructure as well, which is what people aren't quite have. It hasn't clicked for the average person or the average investor yet. And this is where your thematic process goes in. Is you're saying, hey, we're ahead of the curve. It is really cheap. Can we get into commodities or can we get into mining? That's your main thesis. Is that right?
Yeah, yeah. Yeah, no, I think we have a 5 to 10 year period of investing in this space, and there's going to be a lot of ways to skin the cat. There's going to be people that will focus on energy alone, right? And natural gas opportunities, nuclear opportunities. There's going to be things on the solar panels. Oil. I had never. I don't recall being this bullish in oil in a long time. I mean, not oil specifically, but oil companies. I just think they carry also a lot of opportunities right now at these valuations. Um, and as you start seeing this demand for resources increasing, you have to think about what are economies that will really benefit from that, right? Economies that will see growth on the back of higher commodity prices. And what is remarkable about this type of thinking is that most of the countries that have very clear correlation with commodities on the way up and on the way down are today priced as they are likely to see pretty much no growth. That's why you go to a place like Brazil and you look at the PE ratio of companies, they're trading a single PE ratios. Okay. Why does a Brazilian bank trade a sub 5 PE ratio today? It's because the market is thinking that they're not going to see the growth. But if there is a growth environment in commodities that then indirectly or directly causes the whole economy to grow, do you really think those banks are going to grow pretty much stagnantly for the next 5 to 10 years? I don't think that's going to be the case. So you have to extrapolate this thesis and start looking for these sort of other things that are likely to be very mispriced in this world. You know, if I'm wrong about all this and the dollar appreciates and does very well and yields go higher, then it's a very different world and very off and most likely we're going to see a very deflationary environment. Emerging markets won't do very well. I just don't believe that's going to be the case. I'm I'm okay taking that type of risk in my own capital and clients' capital.
Just a quick one on this. So do you see commodity currencies? Obviously, Canada has a lot of mining, Australia has a lot of mining. You said Brazil. Do you see commodity currencies obviously outperforming the US dollar because of this thesis? As you just said, the flow on effects.
Yeah, about 9 months ago, we made a decision, um, my wife and I, to buy a house in Brazil because of that thinking. No, that's one way to have foreign currency exposure into an asset. I don't want to just carry Brazilian reais in my pocket. Like I'd rather own an asset that is priced in Brazilian reais. Uh, so yeah, I mean, just a reminder that people don't know about this, but Ibovespa, the most boring way to invest in Brazil, if you put $1 million into Ibovespa in the beginning of early 2000s, you would have grown your money to about $18 million by 2011. So how would you would need to be long the 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 Brazilian market in the local currency. Actually, that was a calculation in US dollars. The local currency was way more of that. So I don't look, I'm not saying that those currencies are going to do very well better than gold. That's not my point. As long as they don't move much, right? If they stabilize where they are, so you see stabilization of those currencies because of a weaker dollar, and on the back of that you also have lower yields that allow these economies to grow much faster and higher commodity prices, you can see explosive moves. Like people are really underestimating what you could see in the back of these kind of 3 to 5 years windows. If you have a like all people are like you can kind of notice that smart money is coming into it because not only you talk to them and they are doing this, but also you can see the behavior in the markets, right? When you have a down day in markets, like markets are down 2, 3% of those rare kind of days in the US markets are 1.5%. How much are the emerging markets space down? And not as much. And so um clearly there's money rotating into those areas. And yeah, it's gonna be very exciting in my view. Really, really exciting.
You said Brazil part of BRICS, right? Obviously, the B and the BRICS. What do you think is the BRICS impact? Because obviously, we are seeing a multipolar world. regardless of what the Western democracies are doing, BRICS are actually moving away. And you see China, Russia, India, they're not slowing down on whether it's coal consumption or electric generation. How do you think the BRICS countries are the ones leading the whole commodity bull market?
Yeah, they're going to do well. Yeah, I mean, I think India could do very well, but not a commodity led economy. Definitely a commodity importer, so that's a different story. Um, but they could, I think there's three ways a country can do very well. It either is resource exposure that they have, and we're in a commodity bull market, and you benefit from that. Saudi Arabia is definitely that, and Brazil and others. Or you have
Russia, yeah.
demographics, where definitely hits India there, right? India's got the perfect demographics, and some African countries have that too. And number three would be technological advancements. You hit like the US has, right? With internet and now AI can certainly generate a lot of growth if you have those periods of major technological changes in a certain country versus others. Um, so there's different reasons to invest in different places. I think that the Indian case does not fall into the commodities case; it falls into the demographics case. So I think it's a different story um, to have a view on. Doesn't mean it won't work. Like that's very likely to work as well. I wouldn't bet against it. But I think there's some emerging markets in the BRICS specifically. Um, South Africa as part of the BRICS itself. Uh, could do well. You have China as a commodity importer, so it's a little bit of different. And then you got Russia is a commodity exporter, but it's a total political mass, right? And it becomes non-investable for a lot of people or institutions. We're not talking about personally. We're talking about large institutions that are not allowed to put capital there in most cases. So you have kind of a default situation where you come back into an economy like Brazil. That's why I've been so bullish there, and I hated Brazil as an investment for over a decade, and now I've turned very bullish. But it's not just Brazil. It to me is it's I think the whole South America region or the Latin America region is going to benefit tremendously, and the reason for that is because not only you have this resource rich area that is the obvious take on this. You also see political changes, believe it or not. You saw Argentina, you've seen Bolivia now, you're seeing Chile and potentially Brazil, El Salvador. And the last thing I was going to say that is even more important is that look at the emerging markets index and look at the weightings. 70% of the weightings in the emerging markets right now, it's Asia, and almost no capital is going into Latin America. I really don't think that would be the case in 5 years from now. So I think that money is gonna find its way back into those areas. Even if I'm right for a couple percentage points, that's a big change. And so I like these sorts of stories that have a lot of optionality for things to go right, because you never know, right? These things can go wrong in so many angles, but it's very exciting in my view.
Yeah, good point there, Tavi. It's just a thesis, right? Things could change. And the thing I was mentioning about the BRICS is because the talk of the town is our oil is so low right now because maybe there's a deflationary impact coming, which kind of throws the thesis that you have kind of out the door if deflation is coming in a way. But the point I was trying to make was in the BRICS also China and India are the importers, and Russia, Brazil are, let's say, the resource rich exporters, and South Africa as well. When I travel to India, the amount of infrastructure that's going in, new highways and motorways, and they're building railway stations everywhere because obviously the average Indian is earning more and they want to spend more. So the amount of infrastructure that's going into India, obviously, like China had built, some people say ghost cities, India is now developing. So even my question about the multipolar was even if the West slows down and they don't need the resources, I think East Asia, Latin, and the BRICS countries are still developing. So they will need the commodities and the resources, regardless of whether the Western countries do or not. And as Europe kind of tried to do, they try to cut off their own pipelines from Russia. And now they're actually seeing the inflationary impact and the problems that they're facing in their economies. That's what I'm saying. Do you think, regardless, your thesis wins?
No, I can see a lot of ways my thesis could go wrong, and yeah, I find it funny when people um try to talk about investing without taking risk, and it's just there's no way around it. You're always assuming risk somehow. There's a good book that talks about this called The Art of Speculation. Um that talks about everything in your life is an act of speculation. Who you're gonna marry, who you're gonna be friends with,
Yeah.
what are you gonna eat, what type of diet you're gonna take, and all these little things, what type of sports you're gonna do, and uh college, where am I gonna live? It's all speculation. You don't know if it's gonna work or not, but you start getting better at those decisions, right? And it's the
Yes.
same thing with markets.
So, given the thesis, how do you guys at Crescat or yourself also handle market volatility? And how are you trying to balance the risk versus reward in this? We've just been talking about risk versus reward, but when is it that a thesis could make you think, okay, we've gone wrong, we need to walk away from this? How do you balance risk versus reward?
Um, Look, I don't mind actually sticking with the thesis for a long time. Um, and it's always it's an art of balancing your conviction views and continuing to build on that thesis over time, and always try to learn about it to make sure you're not missing something, and knowing very well the other side of your trade. I think it's always important. There's no perfect way to answer your question of how to really look at. I think the best way to look at risk in a lot of ways is looking at the valuation that you're paying for that idea. Helps you to have to avoid a lot of problems. Um, there's going to be value traps there too that you have to be aware of. But that's where your macro thesis will help you to find optionality for something to work. But valuation is something I pay very close attention to, and I think this world has moved away from understanding valuations. And I spend a lot of time on that because I'm always thinking, all right, what's being reflected here? Are they thinking about growth? Not, what type of growth? Do I agree with that? Disagree? Um, and the more you dive into those types of projections, the more you understand why an asset's value at that price. And volatility doesn't bother me. Of course, nobody likes to lose money, but I've had situations where I'm sitting on cash, and the market is if market is down when and my positions are down, I'm losing money, but I have cash to deploy. Oh, I love volatility. I have zero problems with that. Like, I don't mind that at all.
Are you
Oh yeah,
doubling up in those scenarios? Are you doubling up on those?
I
Yeah.
definitely take advantage of volatility, daily volatility, monthly volatility if there's something to do. Um, I think that the biggest mistake I've made as far as that has been trying to be too cute understanding markets. I've said this before to a few people, but it's funny. Your IQ in markets can be very dangerous because the more you have a very high IQ and you're trying to be too cute, understanding when to come in, when to come out perfectly, that's not the way to build wealth. Actually, it's very difficult to do that because markets are very unpredictable when you get to that kind of stage. So, yeah, I mean, I think that the biggest thing I've been spending a lot of time on recently has been, what moment do I want to sell my positions? At what moment do I think this is a bubble? What moment do I want to realize some of my gains in some of the things that the market has come to me, right? Like 3, 4 years ago, the market wasn't there for mining. Nobody talked about it. Nobody wanted to be invested in it. Now a bunch of people want to talk about it. And so the market is starting to come to that view that I had and others had. Um, and so at what moment do I feel comfortable handing that investment to somebody else and saying, I've made enough. Here it is. I'm gonna move on to another idea. It's something I've been spending a lot of time on. I have a lot of thoughts on that, but it's definitely something I've been um focusing on recently a lot.
So in that case, do you, if you don't mind me asking, do you look at commodity ratios? As you said, maybe sometimes you look at an exit point as well. Are you looking at what commodity ratios might you be looking at? A gold to silver or a gold to oil ratio or something for an exit point, or even for whether it's cheaply priced?
Yeah, that's a very good way to do it. Actually, it's a very, very good way. Like for instance, if you're a mining company, you're not hedging your energy costs today, you're out of your mind, because your margin that you were talking about, that gold price versus where they're producing it in terms of cost, a lot of that, about 30+% of that cost is coming from energy. And that's just predicated on the fact that gold to oil ratio or silver to oil ratio has been so high today relative to history. And so, but history shows that those ratios don't last. That doesn't mean gold and silver are going to fall, but maybe that means that oil could rise.
Oil
So,
could rise.
I'm concerned about that. I'm concerned about energy cost. I think you should be concerned about energy cost, and you should be thinking about, how do I protect my margins? If you're a miner, let the price, do not hedge your gold, your metal prices, but think about hedging your cost. How do you protect your margin? It's your biggest question right now as a miner, in my view. So yeah, so definitely look at those things. I mean, if you get gold to silver ratio at 2, sorry, at 20, where we're now at 80, yeah, I'm probably going to change my view on where silver should go. Or if we're at 40, I'll probably be less bullish than I was. I mean, if you're not adjusting your views as prices come to you, that's a dangerous game. So
Yeah, exactly. Then you're holding on for too long and the market's turned if you just, some people get greedy. So ratios are a great way of looking at that. Tavi, I just want to ask you a couple more questions. How do you see the next few years playing out? Do you believe we've talked a lot about commodity uses with geopolitics and wars and all of that? So, what are your next 3 to 4 or 5 years looking like? Do you think we do have a geopolitical problem when we go into wars because there's a lot happening in the Middle East with Israel, with Russia happening? Obviously, that also makes commodities more expensive. We go into war. Just a quick one on that. And then I'll just ask you one more question about the economy.
I think likelihood of geopolitical tension happening in the next 3 years is very high, and there's some assets that are not reflecting that risk, like oil. Um, Impossible to know where, but I think it's very high. We're starting to see a world where people are starting to move lines and maps and saying, "This is mine, this is not yours," and that's usually has lags, doesn't just starts and stops, and just I think that we're seeing that in different parts of the world, not just, Ukraine and Russia, not just, US saying they want to, have Greenland or other things like that. We're also seeing that in Venezuela and Brazil and in other parts of the globe. And so, um, India and Pakistan and others, those things are all happening. And so it's impossible to know where it's going to come from. But we know that the risk is being priced out of the market right now, and so the risk is really high on that front. Very, very high. I would say 0 to 10 is like a 9.5, if not 10. So it's very
Yeah,
high.
I totally agree. And that's obviously puts a rocket under the price of commodities as well.
Mhm.
So, my next question would just be, what do you see governments are going to have to do to get out of these debt and deficits? Is it hyperinflation? Do you say, or do you see what coming is a debt deflation or a stagflationary period?
No, I think hyperinflation is a potential consequence, but not my highest conviction idea. Uh, I think a combination of very high inflationary regime with low growth. So stagflation would probably be it's already taking place, right? I mean, we're still, most of the growth we're seeing is inflationary growth. And um, yeah, I think that's probably going to be what we're going to see. But you got to be careful because 10 years, 15 years from now, once we have built up all the infrastructure we need for AI, we're going to get into a very deflationary world. And so I'm very flexible for that view once the timing is right. But at first we need to build up things. We haven't built up enough. Once we build up, I'm gonna change my view very quickly on that. So
Yeah, fair enough. Obviously, we talked about gold. So there's a lot of commentators who say gold is the one that signals the commodities bull market. And gold is obviously often running. And now recently we've seen silver go over $40 as well. What would be two, three, five commodities that maybe let's pick three commodities that you'd be most bullish on besides gold?
silver is the obvious. Then I would put zinc as number two, copper number three, uh, oil, uh, maybe natural gas. Yeah.
Yeah, yeah. Because I've heard USA also natural gas is going to be the alternative for them. Hey, Jan, this is the part where I stop talking about business and macro and all that kind of stuff, and we just let the audience get to understand Tavi a little bit personally as well. So I hope you don't mind me asking you a few slightly personal questions. But what does Tavi do in his free time when he's not analyzing charts?
Hmm. Hang out with my family and also love to go for runs. Yeah, that's usually what I do. I like to go out and play tennis when I can. Uh and hang out with friends, go to good restaurants and yeah, that's usually I love traveling. So, yeah, that's usually what I do.
You said good restaurants, Tavi. Do you mind me asking? Does your or do you guys cook Brazilian at home, or do you prefer not to have Brazilian where you are? And um, because when I am overseas, I hate eating in Indian restaurants. If I'm eating Indian, I actually want to eat Indian at home because it
Yeah,
tastes more authentic. Is that how you feel as well?
I agree. It's garbage here in the US.
Yeah.
It's hard to find good stuff and I don't blame the restaurants. It's just it's hard to get access to the good stuff and so yeah, it's not good. But, no, I do a lot in my house as well, and it's not hard to, I don't know, cook steak and all that, so I think it's enjoyable too, so I don't mind doing it at all. It's fun.
Fair enough, right? Hey, a book you would recommend to your friends most often?
Most often, if it's a person that wants to learn more about mining, I think the Men and Mines of Newmont, which is the story behind Newmont, is a good book. If it's a book about macro, I think Lords of Finance is a good book as well. So, yeah.
Yeah, fair enough. Thank you. Is there anything else you've learned from being in this industry, Tavi?
I think most important has been trying to be very independent on your thoughts and build your own convictions. I spend very small amount of my time reading other people's opinions, a lot more building my opinion. Like 85, 90% of my time is spent on my own things. And I think that model has brought me where I am right now, and I don't, um, I don't foresee any changes on that. I definitely think that that's a way to build wealth and to also build conviction on ideas and find things other people are not looking. So, um, if you want to find something other people are not looking, why are you looking at other people's research?
Yeah,
So,
that makes
uh,
sense.
you know,
Exactly.
it's just
Exactly. If you follow the herd, you're not going to get rich and wealthy. It's you got to stand out from the crowd to make it happen. Hey, just
Yeah.
one last one. The best advice you've ever received from someone?
The best.
You can throw in a couple in there if you'd like to share with the audience.
One that I usually mention questions related to this is building our own conviction, because that's where you're gonna have your moments of volatility in the markets. You know, I usually say this: if you invest in mining companies and mining companies go down 30% next day, are you gonna call me and ask me why miners are down? Why, if I told everybody it's a good investment and now it's down. I mean, that's the I get these messages all the time, and that's just somebody who's done zero work, right? Lost, completely lost, and borrow my thesis and did not borrow my conviction and is now lost. And build your conviction, because you don't want to be in that position. You always want to know what to do in different situations. Now, what would I do if that asset falls 50% tomorrow? It could happen. And it's always a good thought exercise on your conviction. Um, so yeah, that would
And
be.
I think you answered that brilliantly earlier, Tavi, because I asked you if something falls, what do you do? Do you double down? And I think Rick Ruler has mentioned it quite a few times. If you want something and it's now half the price, do you get more of it or do you sell out? And obviously you would go and buy more of it because your conviction knows exactly why you're investing in it. And one of my previous guests also gave an example again of Rick Rule, where he said Rick Rule had seen his 10,000 mining investment go down to $2,000 only to then rise to 100,000.
Yeah.
So if you have that conviction is when you hold on to it. And if you have extra liquidity, which you said you do, you leave cash in reserves, you double down on your conviction, and then you profit handsomely at the other end. So it kind of makes sense. Hey, this is a question I ask everyone who I interview because I have a financial consultancy called Success Simplified. So, Tavi, how do you define success?
In what? In markets, in life, and
In
what?
life, it could be spending time with your family. It could be, how do you define success, right? In life, personally.
Uh, I think is spiritual success is very important in that sense. I think, um, and I think surrounding yourself with people you love is also very important. And also would say that money is definitely not there. I mean, I just see money as you know, there's definitely not a lot of correlation between, especially in my life. I can say that very certainty with happiness and money, but there is initial, the first moments you make money, definitely you're happier, but that falls very drastically in terms of the more money you make does not make you more, no, the same amount of happiness. So
Yeah.
falls substantially that ratio. Uh but yeah, what they're living a healthy life in general, I've um love being surrounded by people I love, and that's very important to me.
Okay, perfect, man. That's a perfect place to end our conversation. Where can listeners learn more about you and the firm?
Learn about Crescat.net is the website, and also Tavi Costa is my Tavi Costa at Tavi Costa is my X handle. And you can also find me on LinkedIn, Tavi Costa as well. And yeah, that's where you can find me.
Yeah, I'll put all those links in there anyways, and I definitely highly recommend Tavi's charts and his commentary on this. I'm a big fan, and I think my audience is going to love it as well. So, hey, Tavi, I just want to thank you for your time. I can hear your daughter in the background.
I know.
So she wants to see her daddy. I really appreciate your time, Tavi. Thanks a lot,
Yep.
mate. I really appreciate it. Thank you.
Thanks. Thanks for having me. Take care.
Thanks.